Now in this video, we are going to look at the specific guidances which has been provided in the IFRS 15 related with right to return the assets, warranties, forward and call options, put options, contract assets, non-refundable upfront fee, bill for hold, and customer loyalty programs. So let us look at them one by one. Now, the right of return, if the customer, if we think that the customer is not going to return, means the company need to have an estimate based on their previous experiences that the customer is going to is going to return or not. If yes, if no, not expected to be returned, then that portion or that amount will going to be recognized as a revenue, and the contract entries are contract asset to credit to revenue, and the receivable to contract asset. Contract asset because you normally have to when if you're not entitled to bill yet, then it will be considered as contracted asset. If you have already billed it, then it will go to receivable and credit the contract asset. When the if you think that the company there are certain customers or portion of customers that they are going to return the goods and services, then for that particular portion you're not supposed to recognize the revenue. In fact, you need to recognize the you need to make entry for right to recover the asset and refund liability. So you need to recognize the liability and right of recovering the asset. Now this is if they come and do the return, then the entry will be reversed. Otherwise, the entry will not be reversed. So this is going to be continuous. Then the other thing is the warranty and decision tree. So that if let's say the company is giving a warranty, let's say 2-year warranty or 3-year warranty on any goods and services, then how you are going to recognize the revenue and the cost related with it. So the first thing is to assess the nature of warranty. Does the warranty has an option to purchase warranty separately? Does the customer has or is it bundled together? So if the customer is they have a separate when the company is selling the warranty as a separate performance obligation, then it will be considered as a separate performance obligation, and you will recognize the revenue separately and costs related to serving the warranty separately as well. But if it's not, then it's a part of the same goods and services. And then we need to look at if the company is providing the warranty service in addition to the service already provided. If yes, then again it's a separate performance obligation. If no, then we just have to no need to break down the performance obligation, and we just need to make a provision under IAS 37, which is on the warranty. So how you're going to make the provision? You are going to look at the past data of warranty, how much cost you have incurred over of the revenue in servicing the warranty claims. So that amount you need to set aside as a provision every year to serve the warranties. If the warranty is required by law, then it is not a separate performance obligation. Normally, the lengthier period are more likely that it's a separate performance obligation, and the task required to provide assistance complies if the task required to provide assurance that the product complies agreed specification is not a separate performance obligation again. So these are the guidance which is given in IFRS 15 for related with the warranties. Now, the things related with the forward, return, or purchased call options is that when you are sending return, writing, or purchasing the call options, then the repurchase price less the original selling price. If the repurchase price is lower than the original selling price, then you need to account for it as a lease, because basically what you are doing is financing, right? Because it's called a lease. If it's not a sale and lease back, then if it's sale as lease back, then IFRS 9 will be used. But if the repurchase price is not less than the original sales price, then it will be account the contract as a financing arrangement. If we are comparing the repurchase price we need to also look at the time value of money. If the contract is financing arrangement, the entity will continue to recognize the asset and will also recognize the financing liability. If the option lapses unexercised, the entity will de-recognize the liability and will recognize the revenue. So it depends on when the customer is coming back and saying, okay, we want to sell it back to you at a higher price or at a lower price. Then you need, I mean, normally you wouldn't buy for a higher price, right?